Yes, I think overall, from a tax perspective, I was expecting something more. There's been no changes to the personal taxes, no changes to the corporate tax, other than a few changes to taxation for banks and insurance companies. Definitely, the budget is pushed towards affordable housing and green economy with some incentives that they've put in there.
And it seemed like almost like a directionless budget. And especially in light of the coalition between the NDP and Liberals, I guess we expected significant tax changes, more to the negative from the perspective of businesses and individuals. But I think with all the economic uncertainty, what's going on in Europe and Ukraine, I think the government was perhaps between a rock and a hard place and fairly gun shy in terms of any major tax initiatives in this particular federal budget. Several previous budgets, CRA has more money. They received another something like $1 billion in budgeted funds. So, what's a business owner to do? Well, get ready. Be prepared for a CRA audit. Have your books and records in order. Use a good accounting firm to not just make sure your book's balanced, but the expenses are legitimate, they're supportable. Even talk to your CPA firm and consider engaging them as if they were CRA, like a mock audit. Are you ready? What tax filing positions are we taking? What's our exposure? So, just have your documents, your documentation in order, and be ready. So, if CRA pays your business a visit, they can be dealt with professionally. Have all the documents they need in right there and then, and hopefully it's a pain-free process. Or they may decide to hone in on specific items of exposure. For example, travel expenses, professional fees. These particular items have been in CRA's crosshairs over the last couple of years. So that's something you can look to. Also, some accounting firms are offering Audit Shield insurance, which basically you pay a premium, and if you're audited, your professional fees up to a certain maximum will be covered in the event you're audited, which I think is becoming more and more likely as our deficits seem to widen. For business owners was the change in the small business deduction limit. That affects more well-established larger mid-market businesses. So the small business deduction is the most favorable rate of tax in Canada on the first $500,000 of corporate profits. Federally is currently 9%, and there is a grind on the small business deduction. When a business's taxable capital reaches 10 million, and there's a gradual grind of the small business deduction when that taxable capital is between 10 and 15 million pre-budget. What the budget did was it increased that taxable capital upper limit from 10 to 50 million. In other words, a much more gradual grind on the small business deduction, making it more available to more mid-market businesses.
Yeah, so for individuals, I would say that the benefits that came out of this budget are really directed towards the affordable housing. And specifically, again, they introduced a tax-free first home buyers savings account, which is works similar to an RSP. You can contribute up to $8,000 a year to a maximum of $40,000. So basically, if you're contributing $8,000 a year, it's over a 5-year period, the contributions are tax deductible, similar to an RSP. But then once you draw the money out to purchase the home, those funds are tax-free and they grow tax-free. So that's definitely a plus there. They've also increased the home buyer's tax credit. That's actually been doubled from. It was a tax credit of $750, now it's $1,500. They also increased the home accessibility tax credit that would apply to any renovations that you need to do to a home for access for disabled persons. That has also been doubled. And they've also introduced a multi-generational house rental tax credit, which allows again, family owners who want to have maybe their parents or again, disabled relatives to live with them, they can spend up to about $50,000 to, again, make improvements to their home so that they can have their seniors / any related persons disabled live with them. They have introduced a new rule when it comes to property flipping. Again, over the years, this is nothing really new. I think they just put it in black and white, today, in order to claim your principal residence, you need to hold the property for at least 12 months. Again, over the years, there were, some people would buy and sell and flip homes and claim principal residences. It's always been on the radar of CRA. They're looking at the frequency of how many homes they're turning around in any given time period. But again, they've now just put it into black and white. On top of that, a GST component that also impacts the real estate market, if you like, from an investment point of view. It's selling real property through assignments. So again, over the years, there's been, especially with the real estate prices that we've had in the past couple of years, there's been a lot of sale of properties through assignment. So people don't even take ownership of the property first, and they sell them. They were flipping them, not aware of the fact that HST does apply to the sale of an assignment. So there were certain exemptions where if you bought for the intent to live in, so for your principal residence, there was a carve out for that. However, again, it's always very hard to prove the intent when when you haven't even taken possession of the home and you're selling it on an assignment. So what the new rules are proposing is that basically, regardless of what the intent is, HST applies. So when a person sells a business to a non-related third party, they, again, assuming the company meets the conditions for qualifying business corporation shares, that the person selling the shares of the company would be entitled to the lifetime capital gains exemption, which today is just around $900,000. So that's tax-free capital gains. However, with transactions that happened between related parties, so even between parent and child, there were restrictions, and those transactions were always at a disadvantage, because essentially, if in order for the parent, for example, to claim capital gains exemption, the child would have to finance the purchase with personal tax dollars, which is typically more expensive than financing it with corporate tax dollars. So the governments looked at that and basically kind of said, for genuine transactions. They were looking at how they could amend the legislation such that the even transactions between related parties can also take advantage of the lifetime capital gains exemption without any disadvantages. The legislation went through in the latter part of last year. However, once they released the legislation, it was found that there were a lot of, call them loopholes if you like, where, people could, if you like, abuse those rules to be able to do what we call surplus stripping, essentially bringing out money of the company at capital gains tax rates without there being a genuine, legitimate transfer of business. So the government has said that they're going to go back and relook at the rules and make any revisions if necessary.